How many times this happened to you? You analyzed the market and entered a position, you set a stop loss for your position, then the market suddenly moved against your position and your stop loss order triggered, and shortly after the market reversed and trended in the direction that you had initially analyzed. You analyzed the market correctly, but you ended up with loss just because of a sudden and unexpected move in the market. If this has happened to you, you should know that you got stop hunted by large traders who are also known as whale. Large traders use stop hunting technique to make profit on their positions by taking advantage of stop loss orders and the way that they work. In this method, large traders or whales push the market in certain way to trigger stop loss orders of other traders. By doing so, those small traders get out of their position, and when the stop loss orders are cleared, the market reverses, and this gives the whales a quick win. I'll completely explain how this happens in practice, so don't worry if you don't get it, and make sure you watch this video until the end because I'm going to teach you two strategies that help you to avoid being stop hunted by large traders or whales. As I said, stop hunting is a strategy that whales use in financial markets like Forex or crypto for making quick and of course large profits. When they see lots of stop loss orders placed near the same price range, by the help of their large capital, they push the market towards that price range just to make those stop loss orders triggered and force those traders out of their position. To make it even more effective and aggressive, they use high level of leverage to make the size of their trades multiplied. So stop loss hunting starts with a collection of stop loss orders that are placed near together in the same range of price level. You may wonder why lots of stop loss orders in the same price level, because the market participants see that range of level as a clear and established support or resistance level or zone. For example, on this chart, which is the price chart of Bitcoin on 1 hour time frame, you can clearly see that a support area has formed at this price level. Traders who have forecasted advancing of the price entered in a position with a stop loss being placed below the support level, which could be a logical place for a stop loss because this is a support level and will prevent the price from going lower. But whales can take advantage of this collection of stop loss orders placed in the same price range because of the mechanics of how stop loss orders work. Let me explain what happens to stop loss orders in a normal situation. When there are a cluster of stop loss orders in the same price range, these stop loss orders actually become the future supply of sellers. In other words, in this price range, there are many people who are ready to sell and they have already placed their sell orders. So when the market hits this level, there are more sellers than buyers. There aren't enough buyers to match the sell orders, and this causes the market to go to lower prices. And when all the stop loss orders are executed, the balance of the buyers and sellers will shift. In other words, the number of sellers will reduce and the number of buy orders will increase, and this creates advancing of the price. And now to this situation at stop hunting, large traders or whales enter in short position with very large size of trades to push the market towards the stop losses to force them out of the market, and then they close their short positions, which means that they need to buy back the asset. And this high buying pressure begins to fuel the strong advancing of the price and having the market in the expected direction that traders had originally anticipated. Now you may wonder, is there any way to avoid being stop hunted by whales? It's very difficult for small traders to successfully manage these kinds of stop hunting techniques that are executed by whales because everything is done very quickly and in a very volatile situation. But there are two strategies that can help you to avoid stop hunting to some degrees. Before we continue with the strategies, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, the first strategy is to find areas where stop losses are likely to be placed, which chart patterns or some indicators can help us on this. The goal is to find horizontal support or resistance levels that are more likely to be used by market participants for placing stop losses. These levels are typically the ones that are chosen for stop hunting. For example, on this chart, you can clearly see that we have an established support zone, which below this support zone is the most likely area for placing stop loss by market participants. And whales also know this pretty well, which makes this area of price range as a perfect place for stop hunting. For the anticipated advancing of the price, many traders entered a trade in this consolidation period, most likely near the support level with stop losses below this support level. Here at this point, they got stop hunted. A whale pushed the price down by opening a short position of very large size, clearing all the stop losses in this area and making a quick profit by buying back the asset and closing the short positions. And you can see how this caused the advancing of the price. So in this strategy, we try to discover areas that are most likely to be chosen by other traders for placing stop losses, and then we try to place our stop loss below this area in another reasonable place. By doing so, we can be more sure that the market will not move that far to hit our stop loss. It can happen, but at this level we have more probability for our stop loss to be safe and not triggered by the stop hunting of large traders. And the second strategy is not using round numbers and important prices for placing stop losses. Many traders like to use round numbers for their stop losses because they can remember it easier and to simply evaluate the risk by checking the prices. So round numbers are psychologically a preferred level for placing stop losses or trade entry orders, and usually around round numbers there are lots of orders that are placed in advance, which makes it an ideal price range for stop hunting. For example, on this chart, which is the price chart of Bitcoin, here we have a support zone around 19,000, which is an important number because it was all-time high a few years earlier, and because of this many traders use this important round number for placing their stop losses. And here you can see that we got a stop hunting clearing all the stop losses that were placed around 19,000. So keep in your mind to place your stop losses far enough away from round numbers and important prices to avoid stop hunting. As I said earlier, it's really difficult to successfully manage stop hunting because everything is done very quickly and in a very volatile situation, but by paying attention to the two strategies I explained, you can prevent stop hunting to some degrees and have higher probability for your stop loss to remain in place and not to be triggered by stop hunting. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.